If you've ever heard the word index funds and just nodded along, then this video is for you. Most people have heard of them. Very few actually understand what they are, how they work, and why so many people keep bringing them up. By the end of this video, you'll know exactly what an index fund is, how it grows your money, and why it might be one of the most powerful tools available to the everyday investor. Let's start with the concept. What is an index fund? An index fund is a type of investment that automatically tracks a market index. In other words, instead of trying to pick individual winning stocks, it holds all the stocks in that index at once. Think of it this way. An index is simply a list of companies grouped together by a common rule. The most well-known example is the S&P 500. The S&P 500 is a list of approximately 500 companies in the United States. When you invest in an S&P 500 index fund, you are not betting on one company. You are owning a small piece of all 500 companies at once. That is what makes it so powerful. You get exposure to hundreds of companies in just one investment. Just remember, what you are about to hear are general explanations to help you understand the concept. Your actual investment decision should be based on your personal situation. Consider speaking to a licensed professional before making any investment. But the math here, it applies to just about anyone. Now let's talk about how this has looked like over time. Over the last 30 years, the S&P 500 has returned an average of approximately 10.4% per year, assuming dividends are reinvested. Let's run that math together. If you invested $10,000 in the S&P 500 index fund and left it alone for 30 years at 10% annual growth, that $10,000 would grow to approximately $174,000. No stock picking, no timing the market, no watching every headline. Just one investment growing over time. Now let's put that into context. The national average savings account in the United States currently owns about 0.39% per year. At that rate, $10,000 over 30 years would grow to approximately $11,200. The difference between the two outcomes? Over $160,000, starting with the same $10,000. And here's why that matters. That gap's not about luck. It's not about timing. It's the result of where you put your money. Now here's the important part. Every investment fund charges a fee to manage your money. That fee is called an expense ratio. Here's what that means. An expense ratio is the annual percentage of your invested balance that goes towards running the fund. And this is where index funds stand out. In 2024, the average expense ratio for a stock index mutual fund was just 0.05% per year. To put that simply, for every $10,000 you invest, you pay $5 per year. Now compare that to actively managed funds. An actively managed fund is run by a team of professionals who are constantly researching, selecting, and trading stocks, trying to beat the market. For that work, they charge more. In 2024, the average expense ratio for an actively managed equity mutual fund was 0.64% per year. That's $64 per year on a $10,000 investment versus the $5 of the index fund. But here's the catch. That fee is not only charged once, it's charged every single year on your full balance, which grows over time. Over 30 years, that fee difference between an index fund and an actively managed fund, starting at $10,000, could cost you nearly $26,000. $26,000 that never had the chance to grow for you. Think of it this way. These are the one force working against your money every single year, whether the market goes up or down. But here's the question most people are thinking right now. If the professionals are charging more to manage your money, are they actually delivering better results? Let's look at the data. The S&P Dow Jones Indices publishes something called the SPIVA scorecard. It is the industry standard for measuring how actively managed funds perform against their benchmarks. Here's what it found. Over the 15-year period ending in December 2024, there were no categories in which a majority of active managers outperformed their benchmark. Not a single one. Over 15 years. And when it comes to large cap funds, the type most commonly held in retirement accounts, more than 90% of active fund managers underperformed the S&P 500 over that same period. Now, that doesn't mean active funds are always the wrong choice. On the other hand, for the average investor building toward retirement over the long term, the data consistently points in one direction: low cost, broad diversification, patient, long-term compounding. That is what index funds were designed for. Now, who is an index fund actually for? The honest answer? Most people who are investing for the long term. If you want broad exposure to the US economy without researching individual companies, if you want to keep your costs low and let time do the heavy lifting, if you do not want to spend hours monitoring the market every single week, an index fund is worth understanding. It is not a guarantee. No investment is. But it is a straightforward, low-cost way to participate in the long-term growth of the overall market. And for a beginner investor trying to build a foundation for retirement, that is a powerful place to start. So let's bring it back to what matters. An index fund is a low-cost investment that automatically tracks a market index, like the S&P 500. Instead of picking individual stocks, you own a small piece of hundreds of companies all at once. The long-term average return of the S&P 500 has been approximately 10% per year. The fees are among the lowest in the entire investing world. And over 15 years, the majority of professional managers have not been able to beat it. That is why people keep talking about it. So if you've learned anything from this video, make it be this: the time to act is now. If this video opened your eyes to something you had not fully understood, you are not alone. But knowing is only the first step. This channel exists for one reason: to make sure you are not heading toward your retirement without the information you deserve. If that matters to you, subscribe, because the next video builds on exactly what we covered today, and you don't want to miss it. Better investments, better future. Thanks for watching, and I'll see you in my next video.